Every single day, businesses are making tons of financial moves, sometimes hundreds, even thousands of them. So how in the world do they keep a perfect, reliable record of every single one? Well, the secret isn't some super complex software. It's actually a foundational principle, all captured in one elegant tool, the accounting journal. Today, we're not just going to learn about it. We are going to master it. I mean, just think about it for a second. Every sale you make, every bill you pay, every supply you buy, how do you log all of that in a way that's structured, in order, and actually makes sense when you look back at it months or even years later? That right there is the core challenge of financial tracking. And the journal, well, that's the solution. And that's where the journal comes in. The absolute best way to think about it is like a business's diary. The name itself comes from the French word jour, which means day, and that's exactly what it is, a day-by-day account of everything financial that happens. It's often called the book of prime entry because it's the very first place a financial story gets written down. All right, so here's our game plan. We're going to start with that business diary idea, then we'll dissect what an actual entry looks like. I'm going to give you a foolproof 5-step method for recording any transaction. We'll see it in action, check out a couple of advanced moves to make you more efficient, and then we'll wrap up with the golden rules you just can't break. Okay, first up, let's really dig into this idea of a business diary. The most important concept here is chronology. Just like a personal diary, you write down events as they happen, on the day they happen. And this isn't just about being neat and tidy. This strict, date-wise order is your first and best defense against financial chaos. It creates a clear story from beginning to end. So we've got the why down. Now let's get our hands dirty with the what. We're about to break down the actual structure of a journal entry so you can look at one and write one and know exactly what's going on. Okay, take a look at this. This is the classic layout you're going to see pretty much everywhere. It's just a simple table, right? It's got 5 columns: date, particulars, a little column called LF, and then the 2 most important columns, debit and credit. This universal format, this is the bedrock of all double entry accounting. So let's break them down real quick. Date is, well, it's the date. Easy enough. Particulars is where the action is. It's where you name the accounts that were affected. Now, that LF column, that stands for ledger folio. Think of it like a page number that points to where this entry gets copied in the next book called the general ledger. It's a cross-reference. And finally, debit and credit. That's where the money goes. And you'll see every single transaction will have a number in both columns. Look, there's a powerful logic to all of this. And to make sure you nail it every single time, I'm going to give you a simple, repeatable 5-step method. This is your blueprint. Step 1, write down the date. Step 2, look at what happened and figure out the 2 or more accounts that were involved. Step 3 is the big one. You use the rules of accounting to decide which account gets a debit and which one gets a credit. Step 4, you just write it all down in that neat format we just looked at. And finally, step 5, you add a short little sentence in brackets called a narration that just explains what happened in plain English. That's it. All right, enough theory. Let's see this 5-step method in the wild, right? We're going to apply these rules to a couple of super common transactions that pretty much every business deals with. So let's imagine this scenario. On January 1st, someone starts a business with 50,000 rupees in cash. So, step 2. What are the 2 accounts in play here? Well, the business now has cash, which is an asset. And it also has the owner's investment, which we call capital. That's a type of equity. And bam! Here's what that looks like in the journal. The business's cash went up. Since cash is an asset, an increase to an asset is a debit, so we debit cash. The owner's capital also went up. Since capital is equity, an increase to equity is a credit, so we credit the capital account. And look at that. The 50,000 rupee debit perfectly equals the 50,000 rupee credit. The books are balanced. Okay, let's do another one. This is something you'll see all the time. 10 days later, on January 10th, the business pays the electric bill, 700 rupees in cash. So what are our 2 accounts? We've got electricity, which is an expense, and of course, cash. And again, let's just walk through the logic. It's super consistent. The business now has a new expense. Expenses are increased with a debit, so we debit the electricity account for 700. But to pay that bill, the business's cash went down. Cash is an asset, and a decrease to an asset is a credit, so we credit the cash account. See? It's a perfect logical system. So, once you get the hang of those basic 1 debit, 1 credit entries, you're ready for some, well, let's call them advanced moves.
The journal is really flexible, and it can handle more complex stuff in a really smart way.
What we've been doing are called simple entries, pretty straightforward. But what happens when one event touches more than two accounts? Like, say you pay both your salary and your rent with one single cash payment. You use what's called a compound entry. Instead of making two separate entries, you just debit salary, debit rent, and then do one single credit to cash for the total amount. It's way more efficient, and it shows it was all part of one transaction.
But what about a business that's already been around for a year? You don't just start from zero, right? That's where the opening entry comes in. It's a special entry you make on the very first day of the new year. It just brings all the final balances of your assets and liabilities from last year into this year's journal. It's basically the previously on for your business's financial story.
Whew. Okay, we have covered a ton of ground. So, to wrap things up, let's do a super quick rundown of the golden rules. These are the absolute, non-negotiable fundamentals of journaling. You absolutely have to remember these 5 things. They are not optional. 1. The debit account always gets written first. 2. The credit account comes second, and we usually indent it a little. 3, and this is the big one, the total of your debits must equal the total of your credits, no exceptions. 4. Every single entry needs that short little narration explaining what it is. And 5, everything has to be in strict date-by-date order.
So you see, the journal isn't just some boring logbook. It is literally the first draft of your company's financial history. As the book of prime entry, it is the source of truth. Every other financial report you ever create is built on the foundation you lay right here in the journal. If you master this, you have mastered the most fundamental skill in all of accounting.
So there you have it. You've got the format, you've got the 5-step method, you've got the golden rules. You have the entire blueprint for telling a clear and accurate financial story. The only question left is, are you ready to start writing your business's story? The journal is waiting.